Welcome to The Explainer. Today, we're unpacking a truly wild paradox in the market, looking at the financials of the internet's ultimate toll booth, Verisign. Honestly, if you've ever typed a .com address, you've interacted with them. But here's the thing. When we pop the hood and run this company through the valuation frameworks of legends like Warren Buffett, Peter Lynch, and Benjamin Graham, we get this genuine, head-scratching paradox. On one hand, we're looking at a cash-printing monopoly, but on the other, major flashing distress signals. So let's figure out what's really going on here. Think about this massive number for a second. 181 million. That's the combined total of .com and .wet domain registrations acting as Verisign's foundational infrastructure as of August 2026. And every single one of those domains pays a recurring fee. When we look at this through the Warren Buffett lens, this isn't just a competitive advantage, right? It's the ultimate, impenetrable economic moat. They literally own the toll booth.
All right, Section 1, the domain name moat, controlling the internet's toll booth. To break that down, out of those 181 million domains, over 168 million reside in the .com registry alone. The .net side brings in another 12.6 million. And because the idea of a major business actually switching away from a .com is, well, practically unthinkable, Verisign enjoys unparalleled pricing power. It's an incredibly sticky, highly predictable recurring revenue stream. Moving into Section 2, outstanding earnings, delivering resilient and steady growth.
The first half of 2026 was just stellar for Verisign. We're talking about a very steady, methodical step up. Q1 pulled in $429 million in revenue, and that climbed to $435 million by Q2. That's a solid 6% year-over-year jump. Earnings per share totally followed suit, stepping up from $2.34 to $2.38. Now, if you're an analyst building a discounted cash flow or DCF model, this kind of highly predictable owner earnings is exactly what you want to see.
And that reliable growth flows directly back to the shareholders. Peter Lynch would likely look at Verisign and immediately categorize it as a classic stalwart, a slow, steady grower that just constantly rewards you with cash. We've got a consistent timeline of dividend hikes here, bumping up from 77 cents in 2025 to 81 cents per share in 2026. Plus, they back this up by buying back nearly $200 million of their own stock in just the second quarter of 2026 alone.
Which brings us to Section 3, the margin masterclass. Unbeatable profitability. Okay, pause for a second and just digest this number. A staggering 68.18% operating margin in Q2 of 2026. That means for every single dollar Verisign brings in, over 68 cents drops straight down as operating income. Most tech giants who, actually have to invent and build new products would absolutely kill for margins like this. It is a literal masterclass in operational efficiency. And no, that wasn't a one-off fluke. In Q1, margins were 68.45%. In Q2, 68.18%. In fact, over the last 5 years, their annual operating margin has floated elegantly right between 66 and 68%. Because running this registry requires very low variable costs once the infrastructure is built, the toll booth basically acts as a highly predictable cash printing machine. So right about now, you're probably thinking, wow, this is the flawless stock. Incredible moat, sticky revenue, unbelievable margins. But as analysts, we have to ask the hard question. With margins this high, is the balance sheet actually healthy? Let's dive into Section 4, Balance Sheet Red Flags, the hidden paradox. Here is where the story takes a huge twist. On one hand, we've got those sky-high margins, but on the other, the distress signals are flashing bright red. We have a deeply negative Altman Z-score, a negative debt-to-equity ratio, and some notable insider selling. If we look at this through the Benjamin Graham lens, this stock instantly fails his defensive investor checklist for financial condition. No margin of safety here. To really understand the risk, we have to look at the Altman Z-score. Basically, it's a widely used financial formula designed to predict the likelihood a business might go bankrupt within 2 years. It weighs profitability, leverage, and liquidity. And as a rule of thumb, anything below 1.8 is considered the distress zone. Well, according to Guru Focus, Verisign holds an Altman Z-score of negative 4.8. That is deep, deep in the distress zone. On paper, this is a massive red flag indicating financial peril. But you gotta wonder, how is that even possible with such steady cash flow? And here is the Verisign paradox in full view. They operate with a massive stockholders' deficit of over $2.2 billion and a negative debt-to-equity ratio. Add in 12 recent insider sell transactions, which Peter Lynch always viewed as a pretty big cautionary signal, and it looks downright scary. But, and this is wild, they still score a robust Piotrowski F score of 8 out of 9 for operational health. Why? Because that massive deficit is actually intentional capital engineering. They aggressively use debt to fund those share repurchases and dividends we talked about earlier. They rely entirely on the absolute certainty of their internet toll booth to service $4 billion in liabilities.
Section 5. Future Outlook. Navigating the Headwinds.
Their fiscal 2026 projections predict up to $1.18 billion in operating income, which sounds great. However, domain-based growth is slowing to a crawl. We're talking just 1.5 to 3.5%. Meanwhile, the stock trades at a PE ratio of about 28. If we apply Peter Lynch's PEG ratio, comparing that high PE to their tiny growth rate, the stock starts looking significantly overvalued. Investors might really be waking up to the reality of slow growth paired with heavy debt.
Furthermore, they aren't immune to macro trends. Intense demand in the broader AI industry is driving up the costs for physical hardware across the board. So Verizon is facing higher capital expenditures just to replace equipment and expand capacity. For anyone out there building a DCF valuation, you know that higher CapEx literally eats into your free cash flow, which ultimately drags down the stock's fair value.
So we want to leave you with this final thought. Can the sheer strength of this digital monopoly actually outlast the massive weight of its own balance sheet? Warren Buffett might love the moat, but Benjamin Graham would run far away from that deficit, and Peter Lynch would definitely question the growth valuation. Verisign plays by an entirely different set of rules, executing a masterclass in aggressive capital allocation that leaves absolutely zero room for error. Thanks for joining us for this explainer, and remember to always keep questioning the numbers you see on the surface.